Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Welcome, everyone. This is your host, Steve Meisinger. Each and every week at the ISC, we have FX presentations and ETF presentations. Today, the first of our two presentations, and by the way, both presentations will be presented by OptionSource.net, empowering individual traders and investors, and you should definitely check out OptionSource.net as they're an educational company, and they're there to enlighten you on the markets, help you take control, and please go to the website, OptionSource.net. Without further ado, I want to introduce Jason Ayres. Jason is the presenter of the weekly Outlook at the ISC. So each and every week he talks about what's happening in the currency markets. And today he'll give us a little bit of background on technical analysis and how it applies to FX options trading. Without further ado, I want to introduce Jason Ayres. Hey, Jason.
Hey there, Steve. How are you? The audio is still working effectively here for us?
Yep, you're good.
Okay, good stuff. Well, listen, I blame the winter here. I mean, we were talking about it earlier on, but you know what? Why not? We're not sure what the issue is. We're scrambling around here to figure it out, but it's always a great opportunity to join you online. And as you mentioned, we've got my partner Patrick up at 4:30 with his insights. What we want to focus on today is just really applying some simple technical observations to the pair value charts to help us make some decisions as to what might an appropriate strategy be to take advantage of a particular directional bias, and how we can use some simple techniques just to make more effective trading and investment decisions. So, of course, as always, we just want everybody to recognize that this afternoon's presentation is for educational purposes only, and to make sure that you educate yourselves as effectively as possible before going in and clicking the buttons in a live environment. I know, Steve, you've already highlighted some of the different pairs that are tradable through the ISC, but really, what I find quite fantastic about the accessibility of these options is that, you know, we actually, through our program, have a lot of people that enjoy trading spot market currency and look at sort of trading very short-term biases. But I find that these FX options really complement individuals that want to take advantage of longer-term directional views. And of course, the benefit is that you have an identifiable risk exposure as the option buyer. So you guys are just adding more and more pair values all the time, and really doing a great job at getting this market out to the public. So hopefully this afternoon we'll be able to give everybody a little bit more insight in how they can kind of navigate their way around the markets. What I want to do is just kind of really first give a little brief overview of the whole concept of technical analysis. You know, for a lot of people that have never really embraced the idea of using technical analysis for making trading investment decisions, you know, sometimes there's a little bit of a mythical or sort of unattainable magic about technical analysis. But the bottom line is, there really is no holy grail to any trading or to the technique of trading. Really, what we ultimately use technical analysis as is a tool in combination with a sound risk management principle, and that no matter what your approach to making an investment decision is, the most important one is your risk management. Your risk management principles, of course. What we use technical analysis for is really to help us identify trends, identify key support and resistance levels, and it's out of the identification of these key characteristics in a price chart that we can decide what the most appropriate strategy or course of action is to take. Really, what I look at technical analysis is kind of like a roadmap for a trade, or a roadmap for a trade. So in other words, you don't start out on a journey without at first sort of plotting out where you're going and where you might look to stop, and so on and so forth. And if you do start out on a journey, you want to make sure that you know whether or not you're going in the right direction. So for embracing technical analysis into any approach to investment really lends that sort of aspect to making your trading decisions. From an options purchasing perspective, as the FX options buyer, we can actually use some very simple techniques to establish a directional bias by identifying what sort of a trend is in force. And as we all know, the entire objective of trading is really to identify a trend and then ultimately be able to profit from a move in that direction, or of course identify the end of that trend and know when it's time to lock in your profits. Determining strategic entry points for an option purchase. Again, a lot of people kind of disconnect option buying with what's happening in the underlying security, but we always have to recognize that, these pair values that we're discussing here this afternoon are based on what the actual, or these FX options are based on what the actual pair value is doing and what the currency pair is doing in the spot market. So we really have to be able to sit back and create some sort of a mechanism for determining when is an appropriate time to buy our option contract, because we know that the moment we purchase that contract, we're being subjected to that time depreciation factor. So timing is a very important consideration here, and technical analysis really helps clarify it as far as when to enter and when to exit. Of course, we can also use technical analysis to establish price targets and exits for trade management. Again, I go back to that roadmap analogy, and it's important for you, before you actually commit any capital, to really know where you're going and when to make appropriate decisions so that you can protect that capital and lock in your profits. So you don't let a positive trade turn into a losing trade, or you don't let a losing trade turn into an even bigger losing trade. And finally, strike price selection as well. When we step back and we look at a chart, at a pair value chart, we're able to see the different price levels, typically up the right-hand margin of the screen, and we're able to sit back and see where an at-the-money option might be, or whether or not there's any resistance of where an out-of-the-money strike might be, or support down at an out-of-the-money option contract if it's the case of a put option. So there's a lot of different ways that we can leverage an understanding of a price chart to help clarify our decisions when making appropriate options selections and strategy selections. And that also goes with when we're looking at some of these multi-leg strategies, such as debit spreads, and really determining what the most appropriate strike is to buy, and then where, perhaps if we're looking at a call spread, where an upside resistance level might sit in order to make a decision to sell a call option strike up at that level. Now, on the other side of the equation, we know that we can use FX options to generate cash flow through creating some option writing strategies. And we can really apply the same principles. We can establish a directional bias by identifying a trend. So in other words, you're not going to want to be necessarily selling call options on a particular pair value if it looks like that pair value is trending to the upside. We're going to look at using support and resistance levels, and ultimately write put options below support and write call options above support in order to put the laws of probabilities in our favor more effectively for options expiration purposes. The other is, again, strike price selection for credit spreads and iron condors, which we're going to go in and take a little closer look at here today. So the bottom line is, it all really starts with just understanding how to effectively identify a trend. Now, to keep it very simple, a trend is the direction that the market is going. And people always say, well, you know what, I already knew that. But it's amazing how once people actually get into their positions, how they ignore the fact that if they're in a position that's supposed to be profiting from an uptrend, they ignore the fact that the uptrend is actually changing direction. So by keeping it simple and recognizing why you're into the trade and why you want to get out of the trade using simple trend analysis, it becomes very easy to set rules for yourself. Now, we know, of course, that the market never moves in a straight line, and particularly as of late, we've seen a lot of, a lot of action in the currency markets, and the FX option pair value charts have been certainly showing a lot of interesting moves. In a lot of cases, it's been the U.S. dollar down, of course, but on some of the pairs, we're seeing some interesting consolidation at certain levels, and so it's really how these peaks and these troughs, is what we call them, sort of play out alongside one another that helps us establish really what's happening within the markets. And what's amazing about the options market, and what ultimately drew me into learning more about the options market, is that we can take advantage of an uptrend, we can take advantage of a downtrend, or we can take advantage of a sideways trend. And if we take a look at the AUX, for example, the U.S. versus the Australian dollar, or the CDD, the U.S. versus the Canadian dollar, as we will in a few moments, when we take a look at those charts, we can see that there's definitely been a lot of consolidation, a lot of sideways trading action between some specific pair values that we could ultimately look at taking advantage of. Of course, today's really interesting move in the Canadian dollar, and of course in the CDD pair value, and we'll take a look at how we might be able to take advantage of that just by, again, simply applying some of the stuff that we're talking about here today. Now, really, one of the simplest rules of thumb to apply when reading a price chart is that an uptrend will make higher highs and higher lows. And so as long as we can kind of see that the market, or that the pair value is moving up, moving down, and it's creating these peaks and values, but as long as there's consistently higher highs being made and consistently higher lows being made, we can assume that we're in an uptrend. Now, of course, the opposite side of that equation is that a downtrend will make lower lows and lower highs. But again, it's really amazing how people that get caught up in taking advantage of an uptrend fail to recognize when that uptrend is actually changing direction, simply because the highs are actually no longer being made higher. And again, so keeping this simple information in mind can help you navigate in and out of your positions much more effectively as well. Now, we can use these peaks and troughs to draw what we refer to as a trend line. So just going to give you a little bit of an example on that right now. Here we're looking at a chart on the EUI, which is the U.S. dollar versus the euro. And ultimately, if we were to look at an uptrend, we can see that that we've established a couple of key points here. You'll notice this pivot point here, as I call it, and this pivot point here. And the idea is that as long as the peaks or in this case the valleys are respecting that pivot point, that ultimately the uptrend continues. Now it's when the market, or in this case when the pair value breaks that pivot point, that we can start to be a little concerned about whether or not there's going to be any sort of a continuation. And you can see we ultimately saw that break here. Now, we did find some support, which we'll talk about in a few moments. But ultimately, it wasn't until we started once again making new highs that we could sit back and really reevaluate what direction the pair was actually going. And incidentally, recognize that for these particular pair values, the U.S. dollar is the base currency. So,
Jason? We're still waiting. Jason Ayres going back into the room.
Steve.
Hi, Jason.
Hey, sorry, I'm now on a cell phone. So,
wow.
Oh, I know. This has been interesting. So, listen, I don't want to waste any more time.
Here we go.
I want to,
hey, you're back. Thanks, Jace. Appreciate it.
Yeah. Sorry, guys. Sorry, everybody. This has been a real technological catastrophe here. But anyways, let's move forward here and continue with what we were discussing. Ultimately, again, utilizing that trend line to identify a particular directional bias, what we're ultimately doing is, again, for a downtrend, we're identifying the peaks and the troughs, and we're drawing our trend line across the higher points, and recognizing that as long as the pair value action respects that trend line, that ultimately we are continuing a downtrend. Now, sometimes it's a little bit of a challenge when you're looking at a volatile market to establish a trend line. So one of the easiest things that you can do is to integrate what's known as a set of moving averages. So when we actually put a chart up here once again of the EUI, which is the US dollar versus the euro, what I've done is I've just added a simple 8 bar and a 21 bar moving average, and the 8 bar is the blue bar, 21 bar is the red bar, and the idea is that as the blue crosses below the red, we have the start of a downtrend. Once the blue crosses back above the red, you'll see a start of an uptrend, and so on and so forth. So as you can see, as I highlight these particular levels, even though there's a lot of volatility with respect to the EUI and the price action that's taking place, rather than being worried about having to draw a specific trend line, the moving averages take essentially the last 8 bars, and in this case we're looking at a daily chart, so the last 8 days, and plots the blue line, which tends to hug the price action or the pair value action a little more closely. And then we have in there, for a little bit of a bigger picture trend analysis, the 21 bar. And it's just a very simple way that you can sit back and really establish a particular directional bias. So if we were to take a look at the EUI presently, we can see that that the trend is in fact to the downside, although we've seen a move higher and that it's testing that 21 bar moving average. You can see, for all intents and purposes, that that the trend is still to the downside. So the idea is that how can we incorporate this bit of information with the idea of recognizing support and resistance? Well, support and resistance is to me really the foundation of trading these markets, and a lot of people have different opinions. But the idea is that when we can identify these strengths and weaknesses, or the support and resistance levels, we have the ability to ultimately be able to identify targets, identify specific entry points, and so on and so forth, that once again help us build our roadmap to ideally a successful trade. So lows are considered support, highs are considered resistance, and when we take a look at this latest chart on the AUX, which is the US versus the Australian dollar, you can see that on a number of occasions the pair has actually tested that 98 level. Well, because there have been a number of tests on that 98 level, we would consider that level to be a key support. Now, the idea is that we could either see a bounce off of this level, but ultimately, if we see a break below that level, that opens the window for a continuation to the downside. And we'll talk about how we can actually leverage these observations through our strategy selection in a few moments. But just get comfortable with identifying these levels and understanding their implications. If we take a look at the CDD, here's the U.S. versus the Canadian dollar. A couple of really interesting things that we can observe on the chart. First of all, we'll notice that we have a support level through here, just at that 100 level. Well, we need to recognize that previous support becomes resistance. So ultimately, looking at what's been happening as of late, you can see down here just around that 98.50 that level in there we would be able to consider support as well. So what happens is we can get markets, or we can get in this case currency pairs that are trading within a specific range, and there are a number of different option strategies that we can implement to take advantage of that as well. Now, when we're talking about our strategy implementation and considerations for establishing a directional trade, we can take a look at the EUI here, and in this case, you can see that essentially the snapshot was taken yesterday afternoon. But if we were looking at taking a bullish opportunity, well, ultimately, one of the first signs that a downtrend, which is what you can see in place here, is starting to change is, of course, a cross of that 8-bar moving average over the 21-bar moving average. So that really sort of sets the tone for a particular directional bias. The next important consideration is where is there a resistance level? Because one important consideration about a resistance level is recognizing that we could get a move up into that level, but ultimately, because traditionally we've seen the market reject or the prices reject at that level, that there is the possibility that that's going to happen again. So the confirmation actually comes once the prices break through that resistance level. At that point, we can look at buying our call options, because number one, we've seen a change in trend. Again, just to reiterate, we've seen the 8 bar in this case was below the 21 bar, and now we see it trading up above. And we can see that with a break of this resistance level here, we have an opportunity to buy some call options. Now, we can take it one step further when we're creating that roadmap, and we can say, okay, well, if the pair continues to trade to the upside, where might there be a logical area to target? Well, what I've done is I've just taken a look at a couple of levels where we've seen prices consolidate a little bit, and I've established that as a target. Now, Steve, just a confirmation that you can still hear me. Just want to make sure if maybe somebody just type into the chat box, because just sort of a beep on my phone. And okay, perfect. Thanks, guys. Appreciate that. So what a couple of things that I want you guys to recognize with this chart as well is, number one, even though we set our targets, there is the possibility that prices can exceed our targets, and that's why it's important to establish, secondary and in most cases, at least with our trading here, a third target level, because we can actually break down the way we manage our trades based on those targets. So, for example, we hit target number 1. So let's dial it back a little bit. We hit target number 1. Well, that's an opportunity for us to take some profit off the table and move a stop in place to make sure that we ultimately do not turn that profitable trade into a losing trade. Once that's in place, then we can look at our second target, and you can see here in this case that we did have a follow-through into that second target. But what it means is, even though we've made some adjustments, we're still able to participate in a continuation to the upside. Now, once we do that, we're going to make an adjustment to our stop once again, and if it so happens that the pair turns around and breaks below that first target, well, you know what? We get stopped out of our position, we move on, and we find another opportunity. But one thing you'll notice, I just wanted to kind of bring you back to draw your attention to, is how this previous pivot point here, once the market, this previous resistance level, once the market has broken through that, we can see that there was an extended move higher, but then that previous resistance level became a support level for the pair from whence it bounced and then continued on to the upside. So the other reinforcing factor for this is that recognizing, even though you may have missed an entry, let's say around that 73 level, and you watched the EUI push higher, not to worry, because we had a pullback, we saw support tested here, the previous resistance became support, and that opens up another opportunity to get in and take advantage of a continuation higher. Now, of course, you can also utilize your moving averages as well, and you can see right at this level here in and around that 75.5 price point or pair value point that we started to see the pair, the moving averages roll over, which is, again, a good indication that in all likelihood there's going to be a change in direction. Now, we have to recognize that we can't predict the future, so what we want to do is we want to use these tools as a probabilities gauge. So in other words, based on our past past observations and research, a moving average crossover to the downside typically precedes a change in trend. So even though we may in this case have gotten out a little earlier, the fact is we locked in our profits and we followed our rules. Now, we can actually, again, as I said, just establishing that third target just in case there's a continuation higher.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.